This could be one of the major streams of income. This could be something that you use to, fund your dreams. So I'm going to talk to you guys about what Forex is, okay? Before I get started, I'd like to show you a video. And before I get started, also, will you please, in the chat room, let me know if you are brand new. Let me know if you're new or if you've been on before. I like to see brand new people. Good. You just joined 23rd. Great. Merry Christmas. All right. Good. I like that when I do these trainings, I always see brand new, never traded yet. Okay. Good. How many of you are even new to like the knowledge of Forex? Like, wow, I just now found out that there was Forex. Like, I didn't even know Forex existed. It's brand spanking new. All right, Sharon. Okay. So type in the chat if you are new to Forex, period. Not just new to IML, but new to Forex, period. Because I know if anybody on here is like me, at one point, I didn't even know, fresh as a newborn. I like that. New to Forex, period. Never knew about it. Isn't that something? I want you to understand that I'm going to go through some stuff, and as you attend these 4 Basics for Londons and you get on Lee's trainings and other ladies' trainings, I want you guys to understand that it is absolutely okay if you are confused, okay? Absolutely okay. In fact, I want you to be confused, especially if you're brand new, because what does that mean? That means that your brain is trying to understand the stuff. So let your brain do the job it was built to do. Let it keep on sucking up the information. Don't get discouraged if you don't understand what is actually taking place, because your brain is doing its job subconsciously. That's why we have a subconscious. As a teacher, it's important to see that repetition. Repetition is your best friend. Practice makes perfect. There you go. There's a reason why people say that. And it is the key to learning anything. So you need to make sure that you give yourself room to grow. Give your brain the room it needs to do its job. If you are truly serious about Forex, you have to give yourself the room. And when you give yourself that room, you will actually give yourself the permission to make mistakes, because those mistakes are going to be your best teachers. Okay? So now that I'm done with that, I'm going to go ahead and get started on what is Forex. Here is a video that's going to give you an idea of what Forex is.
Form of foreign exchange. Well, Forex is a bit more than that. For example, companies buy goods from other countries. In order to buy them, they need to obtain the local currency first, just like us when going on holiday. The difference is they will exchange huge amounts. When these companies exchange these huge amounts, they will actually move the price, because the demand for the currency that they need increases. When the demand increases, the price increases. With all this exchanging going on around the world, the exchange rates constantly move. This is how it works. When currencies are exchanged, they have a certain price, the exchange rate. As in any market, the price of a currency is determined by the law of supply and demand. If there are many people or companies that want to change euros into dollars, the price of the dollar will rise against the euro, and so the exchange rate will change. Let's use an everyday example to explain how you can actually profit from this. Say you live in Europe and went on holiday to the United States. Let's say that you changed your 500 euros into US dollars at the rate of $1.4 for every euro. You got 700 US dollars, but you do not spend any money at all. So you still have $700 after you come back. After the exchange rate moved from 1.4 to 1.3, instead of getting just 500 euros back, you actually get 538.5 euros. You have gained 38.5 euros simply from holding your money in dollars while the exchange rate changed. This is essentially how we trade in the Forex market. We buy a certain amount of a currency, hold on to it whilst the exchange rate moves, then change it back, making money along the way. How to decide when the right time to buy and sell is exactly what we teach you throughout the rest of our learning lessons. As you can imagine, traveling a lot and saving a bit of money on your holiday budget and then exchanging it, it's not really a practical approach to trading currencies. Fortunately, there is an easier way to do this. You can trade currency through online exchange offices called brokers. What this means is that you can exchange currencies online throughout the day and take advantage of the constantly fluctuating exchange rates. Just as in the example of when you went on holiday, you can buy different currencies and make a profit as the exchange rates change. This is trading the Forex market. Trading Forex online with a broker has many benefits. You can trade Forex from your home or anywhere that you have an internet connection. The Forex market never sleeps. It is open 24 hours a day, 5 days a week, and so can suit your daily routine. You do not need a huge budget to get started. As little as $150 is enough to begin trading and building your account over time. Of course, it will require some learning until you get there. To help you learn how to trade in a way that can suit your individual lifestyle, and to help you navigate your way through the Forex market.
Okay, so that video did a good job. I usually like that video because it does a great job of breaking down the initial idea of what Forex trading actually is. So what is Forex? It is a $5.3 trillion a day industry. All right, so the New York Stock Exchange trades about $22.4 billion a day, which is amazing. The Forex, however, trades $5.3 trillion a day. And if you know anything about the movement of money, that is what drives economies, when money is moving back and forth, kind of like a river. As the river flows, you see life. But when a river is stagnant, what do you have? Death and disease and destruction. So you want to see that constant movement. The more the movement, the better, you know, depending on situation. When it comes to money, the more money exchanged, the bigger the industry, the better. And the more room there is for people like you and me to get there and make some money when we start to incorporate, you know, good risk management and our knowledge, okay? So now, what is Forex made up of? It is made up of currency pairs. It's important that you not only know, okay, what Forex is, but what makes it up. It's made up of currency pairs. In the video, it talked about, you know, you're buying and selling currency. Currency is always going to be in a pair. So on one hand, you've got, you know, let's say here, I actually have some examples. You might have, you know, one country's currency, you want to exchange it into another currency, a country's currency. It will always be in a pair, okay? All right, so there are three types of currency pairs. There's the majors, the minors, and the crosses, okay? I'm going to show you examples of all of those. The majors are basically anything that is traded with the United States dollar. So any currency pair that contains USD are considered majors. The Euro USD happens to be one of the most widely traded currency pairs globally, but then there are many others like USD, JPY, GBP, you can see them all. And then right here, this is the geek speech right over here, the dollar Swissy, the dollar loonie, the Aussie dollar, Kiwi dollar. I mean, eventually, remember when I was talking about treat Forex as though you're learning a new language? It's kind of the same thing, like euro dollar. Like eventually when you start getting into this, you'll start being able to see, okay, this is the speech, this is, you know, this is when they say, hey, I was trading the pound yen, then you'll know what they're talking about. Oh, okay, GBP, JPY. All right, and then the next one is the cross-currency pairs. These ones they don't contain US dollar, but they are derived from major non-USD currencies or more, you know, more established economies and whatnot, such as Euro, JPY, GBP. All right, and then you have the exotics, which are the more emerging. Hold on, let me move on to it. They're the more emerging currency pairs. So things like the USD, they might have the United States dollar in it, but they're more exotic. A lot of times exotics are not as widely traded, specifically because they're not as liquid. And let me just explain what it means when I say liquid, okay? When I go back to the majors are traded most often, followed by the crosses. The reason why people like to trade the majors and the crosses, remember, crosses are anything that contain a more established economy's currency, and then the majors are anything that contains the US dollar. And please, guys, make sure you are taking notes. Make sure you are asking questions as you have them. I constantly have my chat open and I'm always looking. All right? Okay, so anyhow, what does it mean when something is more liquid? Basically, that just means that you have a higher chance of exchanging, because when you are trading Forex, that is what you're doing, an exchange. In order to exchange, you got to have somebody on the other side willing to exchange with you. You can't just, let's say I wanted to, you know, sell purses. If I want to sell purses, I got to have people who want to buy purses. Okay. And then they will give me money. I will give them purses. All right. The more liquid, the better my business is going to be. It would make more sense for me to go downtown or go to a developed area, you know, shopping area, and open up my business, because there's going to be way more traffic. The more traffic, the higher chance for me to exchange my purses for dollars. Versus, you know, I live in Iowa. If I was to go out into the middle of the cornfield, I most likely am not going to find too many people willing to take my trade. You know, it's going to be a lot harder to get that action. All right. It's going to take longer. As a result, we have these things called brokers, which is where you would, like, if you guys you're supposed to set up your MetaTrader 4, and if you've already gotten started, you'll have a broker, which is where you do all of your exchanging, you know, and whatnot. And this is where you withdraw your money and put in your money. Basically, the brokers will charge you more for exotic pairs. Why? Because it's going to be a lot harder for them to find someone willing to take your trade versus the majors. Is not going to be as hard for someone because they're like, everybody's trading it. Like, for instance, Euro USD, like I said, that one is the most widely traded currency pair. Okay. All right. So now, does anybody have any questions about liquidity and the three types of currency pairs? If you do, please put it in the chat room. If I confused you, good. Please ask questions. Remember, welcome confusion, everybody. Please feel free to let me know. Also, I'm a big advocate for reading and whatnot. IML offers IML Academy, where they actually have videos of people going through information. So if you're good at sitting down and listening to people talk to you, Chris Terry, he's actually done some pretty advanced things. As far that some of them are advanced, a lot of them are basic. So if you want to see from the $1 Million Man, he has videos. And then there is Baby Pips, which is really good. It breaks down a lot of what I just talked about, and you can read it at your own pace. So it says, what's the average cost of brokers? How does that work? There is no average cost of brokers. The average cost is the cost is taken out of the spread, which I will actually talk about the spread here shortly. And it varies depending on the time of the day. It varies depending on the season. Like, is it the summertime? Is it a holiday? It really varies. Did like a huge news, you know, did news come out? Countries that are more emerging in their economies that haven't yet established themselves, those ones would be considered exotic pairs. Okay. Do you have to learn all of those charts, or is there a way around that? Now, when you say all those charts, like, are you talking about these charts right here? Because if you are referring to these charts, no, you do not have to. Oh, the MetaTrader charts. No, I mean, you don't. You remember, like, the best way to eat an elephant is one bite at a time. Like, you definitely don't need to just, you know, learn every single one of those charts. A lot of people like to specialize. They like to pick a couple of currency pairs that they like and really just learn those, trade those. Eventually they start to see a pattern, and then they move on and they add more to their portfolio. So no, you don't have to overcomplicate. You don't have to overwhelm yourself. All right. Okay. I hope that answers your question. All right. So now let's go on to when do you trade Forex? Now, I still have, for some reason, the summer sessions up, but basically the times that you know, you can trade Forex. First of all, Forex is 24 hours a day, 5 days a week. The market closes on Friday and it opens on Sunday. Okay. In the summertime, you know, these times are adjusted for daylight savings time. But basically, if you wanted to know when you could trade, like, obviously you could trade right now. But if you want to know, you can go online and Google, you know, what session is open. There are actually 4 trading sessions. There is the Sydney session, which for some reason, not too many people actually talk about that one as much, but you have, you know, more economies like New Zealand, Australian, whatnot. Those sessions are more open during that time. And then you've got they call this the Tokyo. This is the Tokyo session, but a lot of people refer to it as the Asian session. People on that side of the globe are up and running, and their economies are thriving because people are awake. And what are they doing? They're spending money, and money is being moved during that time. Then you have the London session, which is, you know, obviously London, UK, Great Britain, all of those, Ireland, all of those different countries, their economy is moving. Then you've got the New York session, which is more of the Western side, Canada, United States, this side. So basically it caters to each person's time zone. And really, I know people who go to work during the day and they're up at night. They like to trade the, the London and the Tokyo session. And then there are people that sleep during the day, and then they just, or they work at night and they trade during the New York and the Sydney session. The best time to trade, guys, is going to be when you have overlaps. That's going to be the highest liquidity. That's also going to be the most volatile. So that's when, you might see a lot of news releases come out around that time. But what it's going to create is it's going to create a lot of people trading. When you have two different sessions open, that's like two different worlds that are all awake at the same time trading. That increases increases liquidity. And back to your question about your broker, that also can reduce the spread. That can reduce the amount that it would cost for you to trade, because the higher the liquidity, the easier it is for your broker to find someone willing to take your trade, which would actually make it a lot cheaper for you. Okay. All right. So here is another thing. Okay, so it says right here, below is a chart on the average pip range. So you can see Sundays are typically slower moving. This is basically for each pair, and there are a lot of pairs. Oopsie, sorry guys. I'm not asking you to actually memorize every single one of these pairs. Like I said earlier, pick a couple and, just pick a couple of those and, see what they do. You'll start to notice the ones that you like. You'll see ones that are they just kind of move a little too much. Like you can see GBP, JPY. That one is a way more aggressive pair, and some people really don't like trading that. That gold is another pretty aggressive pair. Some really do love trading that. New Zealand dollar, you can see that one is a lot more. Thank you very much, Nicole. And I'm going to read that in just a moment. But you can see that New Zealand dollar is a lot more, lighter traded. It doesn't have as many pip movements. And look, guys, I'm talking pip right now. I said pip, not pimp. That is not a spell check error. That is actually what they are called. I thought it was pimp when I first got started, guys. But anyhow, I will talk about pips and why you should be excited about pips, because I know I was extremely excited about pips. Okay, so you can see when Friday, a lot of people are trying to get their last trades going. Some people, get in and then the market closes on Friday. So there you go. You can trade really 6 days out the week. But it closes Friday. Saturday is your day off. Saturday is study day. That's how I treat it. I treat it as my day to kind of look at my charts, to kind of get, what am I going to do? Strategize for the next week coming up. That's what I like to do, and then other people, they just take that time off. So there you have it. See, Forex gives you some days off. All right. Okay. So now buying versus selling. All right. Now this is back to the question as far as how does it work? What does your broker do? All right. First of all, this here is, it says buying versus selling. You buy when you think that an economy, depending on what it is. First of all, let's see here. This is an actual currency pair, the euro versus the US dollar. All right, this right here is called the spread. Okay, this is what your broker creates. When you decide to place a trade right here, let's say I wanted to, I felt like the euro was going to do really good, and I felt like the US economy was not going to be doing as good for this moment in time. So I'm going to go ahead and, take a buy on the euro. I'm going to buy euro, and I'm going to get rid of my US dollar. That's basically what's happening. What your broker does is this right here. They will go out there, they will place your trade, and then they will accept the trade from someone else for this amount. The distance or the difference between what they, took your trade and what they went out is called the spread. Okay, it's a difference in price between buying and selling. All right, this spread is what you pay when you start. So when you actually take a trade, you typically start off negative right away, because they're taking the spread right out of, they take their spread right at the beginning. The good news about Forex is it's not like gambling where you can lose almost unlimited amount of money. It's basically whatever you start with, whatever you put in, that's what you can lose. I mean, you can look at that as good news. This spread right here is basically how you pay your broker. This spread right now, it's pretty low. During the holiday times, it's going to be a lot higher. Why? Because the major movers and shakers of the actual Forex trading world, the banks, are on holiday all around the world. There's a lot of banks. If you look online, you'll see a lot of countries, celebrate Christmas. A lot of banks go on holiday, along with the next major holidays of the entire world, the New Year. I'd say every country around the world celebrates the New Year. So the banks are going to be on holiday, which is going to produce less movement in the market, which is going to make it harder for your broker to find someone willing to make a trade. A lot of more experienced traders choose not to trade around this time because it's not high liquidity and the spreads are much higher, okay? So for those of you who've been around a little bit, have taken some trades, you might understand what I'm saying. For those of you who are brand new, you might be like, what? What's a pip? And it's okay. You know what? That knowledge will come back to you later. All I'm saying is the spread changes. It changes by the season. It changes if there's high news. It changes, what time of day, what day it actually is. It really can change. It varies. But the Euro USD, the major currency pairs, typically have the lowest spread, which is why people like to trade the majors and some of the crosses. Okay? So here we go. Let's talk about buying and selling. All right, because those are the terms that we talk about when we are actually doing Forex. You're buying something or you are, selling something. It's pretty much kind of capitalism, if you will. All right, so I see a question. Is the spread the price you buy and sell minus, okay, example, 0.1 or plus? No, the spread, remember, sorry, guys, the spread is basically when you look online, when you actually get into your MetaTrader, you will see your currency pairs, and they will look kind of like this. You'll see these numbers, and then you'll see a slash, and then you'll see those numbers. The spread is the difference between the price of the buy and the sell. So basically that price right here minus that price right there, and that's how you get your spread. The broker magically adjusts the spread. Okay, depending on the time of day, the season, the holiday, whatever's actually happening at that moment in time. All right, so a buy. What does a buy and sell look like? So buy means when you think the market is going to move up, then you would place a buy. When you think that the market is going to move down, or not just the market, when we refer to the market, we're talking specifically about our currency, Euro USD. If I go back to Euro USD, like I said, if I feel, hey, the euro has been like that economy, I've been keeping tabs. They've been doing really good here. I believe that economy is going to rise against the US dollar. I feel like at that moment in time, things are going well for that economy. I feel that the US economy is kind of shaky right now, whatever. I'm going to place a buy. I'm buying the euro. I'm getting rid of I'm dumping my US dollars. That is when you place a buy, okay? And what does that look like? That looks like right here, okay? I feel like the euro is going to go up, the US is going to go down. So when you place a buy, this is what it looks like. You expect that the market, remember, buy low, sell high. Make sure you put that in your notes. When you expect the market to go up, it's going up, and that's what will reflect in the market. One economy is rising against the other. All right. Now, on the contrary, a sell means, you know what? Back to this euro. I don't know. They're kind of shaky and whatnot. They just went through elections and people are panicking. I think that the U.S. economy is actually going to do better. So I'm going to sell the euro and I'm going to buy the U.S. Okay. So what does that look like? It would look something like this. Hey, this is the euro economy. I think it's about to tank. It did. So when I put a sell in, you sell when it's high. You buy when it's low, okay? So what do I really want you to see with this? I just really want you to know that, okay, when you expect the market, if you were to just go off of straight visual, I expect these little jiggy-jaggy lines to go down. That would be placing a sell. I expect these little jiggy-jaggy lines to go up. That would be placing a buy. That is the basics, of what I want you to understand, okay? Please let me know if you have any questions about that, all right? Okay. And make sure you type it in the chat. Okay, so buy low, sell high. Are you referring to the lot size? No, I am referring to what it's looking like when what the market is doing. I'll go on to the next slide so you can see what I'm talking about. Okay, and will you be able to watch this again? Yes, you can watch this again because this is being recorded. It says, what is a buy low and sell high? See this market? See how it's moving up and down? Up and down. So you sell when the market reaches a high point, typically a place where the market has gone before and then it's turned around and gone the other way. So a lot of times people are watching, I am watching when I look at my charts, you see now, that's good. I'm watching and I see, hey, the market went up here and then it went down and then it went up here again and then it went down. So I expect when it approaches this area, I think it might go down. Now you got to keep in mind that you actually can't see all this over here. You only can see this little white spot right there. So a lot of times traders are watching this, and then that's when they place a sell. Now, are they right all the time? No, because look right here in this situation. It went up here, and instead of going down, what did it do? It broke through, okay? Not all the time will you get it, all right? Not all the time will you get it. You can't be right every single time. And we try to teach you good risk management because you can't win every single trade. You will lose, and it's important that you understand how to manage what happens when you lose. Not on top of that, but how much you lose when you lose, okay? The only thing that you can control in this market is how much that you lose. That can be actually very empowering when, you know, I would rather be in control of something. So at least I can be in control of how much I lose. Okay. If I know when I enter this trade, I'm okay to lose 50 bucks and that's it, then that's empowering versus, you know, how a lot of us people, you know, we get in. When I was brand new, I would get in and I would just trust my gut. I would just trust my feelings. You know, I would just pray. Nothing against praying at all because I'm big on it. But I will tell you right now, you need to use the skills that you get from IML to actually protect you from guessing, okay? There is no necessary, like you won't always know for sure. So at the end of the day, this is what a buy looks like. This is what a sell looks like. You buy when it's low, you sell when it gets high, okay? And I had a question earlier from someone saying, is it better to pay commissions versus a spread? You can't figure this out to save your life. I think it really depends. You know, it really depends on the type of trader you are. You know, the spreads can vary. You know, I guess personally, I would much rather trade. I would much rather trade the spread only because I get it out the way right up front. I don't have nobody, like if I actually win, like let's say I won $1,500, or if I got $1,500 from the market, I don't want to give the broker 20% or 35% of my winnings. I would much rather break them off that little tiny spread, and then the sky is the limits for me. That's me personally, and it really depends on the type of trader that you are, okay? All right, so, oh yes, thank you, Nicole. What I was talking about is called technical analysis, okay? And that is something that you will get taught. I know Lee actually talked a lot about moving averages. I know that, you know, on IML, you know, basically they have lots of trainings. Oh, shoot, the London session is all about technical analysis. That is where you learn how to trade, so you're not just going off of your gut feeling, okay? All right, so going long versus going short, all right? Long just is another way of saying I'm placing a buy. Short is another way of saying sell. Okay, why did I want to include that? Because we talk like this. Remember, I told you Forex is like another language. All right, and this is some of the vocabulary or some of the terms of our Forex. I'm going long, I'm going short. I had no idea what people were talking about when they said, oh, I'm shorting Euro USD. Go long equals buy, place a buy. When you see this on Telegrams, when Lee or anyone else is throwing out signals, when the harmonic scanner, they will say go long, go short. They might say buy, sell. You don't know, but it's good to know all of those, okay? So there you have it. All right, and now for the pips, the important part, the reason why we're all here. What is a pip? Basically, a pip is the unit of measurement that expresses a change in the value between currencies, okay? It's called a pip. So when you're looking, if you go back to, you know, good old times in class when we talked about graphs, when you are graphing and you make a bar graph and whatnot, and you have to analyze, okay, the graph was here, but now it moved down here. How much did it move? That is the pips that they're talking about, okay? For those of you who are not auditory, you need to see visual, I will show you. Here's an example. If I say Euro USD, this is a currency pair, is at 1.3020, but it moved up 1 pip, then what it should look like is this, 1.3021. Okay, now on the other hand, if I say that it moved down, Euro USD was at 1.3020 and it subtracted, or we lost the pip, then this is what it should be, 1.3019. Okay, that makes sense? Hopefully, basically the pip is nothing more than the 4th decimal number after the comma or after the period, the decimal, basically. Make sure you write that down. This is the pip. right here, the fourth position. All right, you will see. And the reason I want to pretty much reiterate the fourth position is because a lot of times people, you know, like you might see it, most of the time you're not going to see 4 digits after the decimal. You're actually going to see 5, and it can be very confusing to a lot of people. I know it was confusing to me. I'll talk about what that 5th digit is. In order to measure the quantity, you have, here it is. This is an example of what it looks like. So 0.001 equals 1 pip. 0.0010 equals 10 pips. You get the idea. You guys can see this, okay? Remember, it is the 4th decimal place. Over. There's a comma here, but it's really supposed to be a decimal. It was just a really nice clip art. All right, now, here is that 5th digit that I was talking about, the pipette. All right, I hate this little thing because it gets in the way and it's actually cost me some money on some of my sleepy trading nights, okay, or distracted trading evenings. Some brokers offer prices that go up to 5 decimals. I'd say a lot of them, most of them do. So if you say, you know, this is kind of the same thing. Like this is what it looks like on the chart. See all those numbers? 0.30202. This 0 is still the pip. It really is. So if you're looking at, you know, if it goes up at all, if it goes up a pip, this is the decimal that you need to be focused on. What I do is I mentally ignore that 5th digit after the decimal. I don't even see it anymore. When I'm typing it into my calculator, I ignore it altogether, right? And it's beneficial for you to do the same, all right? Now, there is an exception to the rule. There are some currency pairs, such as the yen, you know, JPY, basically. The yen, they have 2 decimal places, all right? Most of the time, though, you're going to see them written in 3 decimal places. And I will give you a visual to put, so you can see this better. So, again, remember, I hope your brains are overheating right now. That means your brain is doing its job. If you're confused, good. Okay, so anyhow, as I was saying, yes, there are some exceptions. There's the yen, and then there's gold. That's another one that happens to, that only, you know, has three numbers after the decimal, but the 2nd digit is the actual pip. Okay, so remember, when you see 5 numbers, it is the 4th digit. That's the pip. When you see 3 numbers, it is the 2nd digit. That is the pip. Okay. Does that make sense to you guys? Type in the chat, let me know. So, good. I'm glad people are understanding. Great. Here is a good visual. Those of you who like to write down stuff, this is a good thing to include in your notes. See right here on this side? This is mostly how you're going to see it in the market. You know what? I rarely see it written like this. I usually see it like this, 5 digits, 3 digits. So you just have to ignore. You just have to act like what you're really seeing is that. This is the pip, that is the pipette. Pipette means little number, okay? It's basically the et means small. All right, so we ignore. Why do we even need to know the pipette then? It is, you know, some brokers like to include that information because it gives you more information about where the market may go or might go. Some people like to employ those in their trading system. In all actuality, the 4th digit is all we really read. So how do you calculate pips? Okay, here it is, guys. The pips. This is where the money is made, and if you're not careful, lost because of poor calculation, which can happen to you at the most sleepiest times or the most distracted times, which is why let me say this right now. If you are sleepy, don't trade. Just do yourself a favor and do not try to trade. I mean, you can demo all day, but do not do live trading when you are exhausted because your mind will make up numbers that are not there. Okay, I'm speaking from experience. If you are distracted like I am, I have 4 children. I got small children that like to talk and call my name so much. Like my name is what they need to get through life. Like it's the air they breathe. If you are distracted, do not trade at that time, okay? Because it's the same thing. It's kind of like trading when you're sleepy. It's like trading under the influence. That's like if you were drinking alcohol, it probably wouldn't be a good idea to trade when you're drunk. It's the same thing when you're sleepy or when you're highly distracted. And let me just put out there, while you're driving, do not trade while you're driving. Here's a pair, New Zealand dollar, all right? On a sale at 4.56567, and you exit at 4.56776. What is the pips that you gained or lost? Now, this is a loaded question. I want you to answer one, how many pips did you gain? Or did you gain any? Or did you lose any? And then the other is, well, how many pips, period. I'll walk you through the first set. What you would do if you're trying to calculate is you basically would take the number that you started with and you subtract it from the number that you are exiting with or ending with, and then you'll get like a decimal number, such as this, okay? So I took this number minus that number, 1, alrighty, yep. And then I got, equals 0.0029, okay? Now remember, what did I say? Which is the pip? The 4th digit from the decimal, which happens to be right here. So what do you really do? Let's make it easy. I'm all about simplifying, guys. You slide this decimal over 4 places. 1, 2, 3, 4. Boom. What do you have? You have 20.9 pips. You guys see that? Like, that's how much pips you gained or lost. I'm glad that makes sense. Make sure you slide it over. As you slide, I hate doing all this little elaborate calculations, dividing this number by, 0.100, all that. No, slide the decimal over. Okay, so now here's the key. Did you lose this trade or did you win this trade? If you go by color, that might give it away. Let me point you to the fact that I said you enter on a sell, okay? Yes, you did lose. You enter on a sell. See what you started with? This is what you entered at. But notice that these numbers ended higher. But remember, a sell means you're expecting the market to go down, right? But instead, the market went up against what you expected. So you did lose. That would be considered a loss. Does that make sense? Does that make sense to you guys? Please type in the chat that yes, I get that, or no. What? Can you explain? Makes sense. Good. All right. Good. Seeing my yeses. Okay. So let's try some more real time. Here's an actual chart. Okay. Because this is really what it's going to look like. When you are analyzing your chart, you're going to be seeing these little, these things, instead of me calling them jiggy jaggies, because that's what I called them when I first got in. They're called candlesticks, okay? And each one of these candlesticks open and close. These little long skinny lines are called the wicks or even the shadows, okay? And they open and they close at certain places, and they just, that's basically, these are called candlesticks. You enter here at let's see here, 1.4500. And you exit here. Was this a buy or a sell? First of all, did I place a buy or a sell? If I entered here and I exited down here. Good. I'm seeing some sells. Excellent, guys. Good job. Yes, you placed a sell. So that's good. I'm glad you guys are saying that. I placed a sell, and this would have been a very good trade. The next question I have was, how much did I gain? How many pips did I actually gain in this situation? All right, what did I actually gain? Go on and type it in the chat. Give you some time to do math. This is where you have to dust calculators off and whatnot. Go on and put it in the chat. We'll start off. Remember, you take the number you started with and you subtract it from the number you exited with. All right, and then you get a number. You might get like a decimal number. Slide it over. When you are calculating, remember, you take this number and you subtract it from that number, right? And so go ahead and put that in your calculator. For those of you who are lost, and remember, that's okay. You will get it. So 1.4500 minus the 1.4245. All right, you should have got a number that looked like this. 0.255, I believe. Kind of like that? Yeah. That's what you should have got when you punch that in your calculator, right? So now, remember what we're supposed to do with this decimal, right? Once you get your decimal, good. You slide it over to 4 places. So, see, you take it, slide it. It's not working out as great. But boom, there it goes. In that 255. That was excellent. Your calculator must be sick. It's okay. Anyhow, does that make sense? Do you guys understand how I did that?